S&P 500 down nearly 20%. A lot of folks looking at their investment portfolios down a lot more. Some growth portfolios down closer to 50%. Folks are wondering, how bad does it get? Some are starting to panic. Man, they're looking at a likely continued stock market crash, a probable recession in 2023. Man, what are they going to do? There's two types of people, folks. The first says, oh, why'd this happen to me? My portfolio's down 20, 30%. Oh, what am I going to do? The second type says, hey, this is reality. This is what I'm going to do about it. They look at a challenge and they say, hey, this can be an opportunity. How do I make the most out of the hand I've been dealt? And they're looking at this likely recession in 2023, a likely continued stock market crash. And they're saying, how do I take this setup and turn it into a potentially multi-generational wealth building opportunity? So in this video, we're going to talk about ideas to crush the stock market crash in the months, quarters ahead. The first step is to recognize reality. Earlier this past week, Jerome Powell raised rates another 0.5%, 4.25%, 4.5%. He's saying he's going to keep tightening because, yeah, the CPI is rolling over. Yeah, inflation looks like it's cooling off from 9% to 7%, but he wants to see it across the board. He doesn't want to just see goods going lower. He doesn't want to just see housing potentially going lower. He wants to see services also coming under pressure. He wants to see that the labor market is cooling off until he sees, goods, housing, services, so labor, triple cherry, all heading lower. He's going to keep tightening, and he's going to keep the rates high to a point where it's tightening the market. It's tightening the economy. It's going to make economic activity tougher. It will likely lead to a recession. Okay, so what else should you know? China just reopened their economy in response to protests due to the prior zero tolerance policy. Okay, how does that impact you? Well, what's the reality? The reality is you have a huge economy, the second largest economy in the world. If they open up, which they're doing, that means you're going to see more demand for certain commodities, like, let's say, copper or oil. So if you see a bid on those things, that makes it harder for the Federal Reserve to do their job. Now, you might see that, both a brake pedal and an accelerator because, China reopening their economy and the U.S., breaking their economy with Fed tightening. But overall, it makes it harder if, let's say, commodity prices don't just drop with the U.S. economy. If they sort of stay, let's say, elevated or bounce around, it makes it harder for Jerome Powell to say, oh, I'm going to start pivoting. He's not going to pivot until he has that triple cherry, folks. And so if he doesn't pivot, that means it's going to take longer to get to a point where you could start having a easing and then a rally in the economy. This means extra innings of pain, folks. Recognize it's pain on. Okay, so how bad does it get? Once again, deal with reality. If you think I'm looking at this wrong, call it out in the comments. I want to understand. S&P 500 around $200 in earnings. Might go lower a little bit in the fourth quarter. We'll see. Currently, this is the little red line jumping around. That's inflation over the last several years. Recently got up to 9%. Now it's closer to 7%. Folks are saying, oh, it's rolling over. Why is Jerome Powell still tightening? What's going on? He wants it down here, folks. He wants triple cherry with a much better labor market in terms of, not hot, not rapidly seeing 6% plus wage increases. He wants to see everything more in line with 2% over time, which is where it historically was. He needs everything to cool off. Housing, goods. Goods is already rolling over. And if you're looking at $200 in earnings power, which is where the S&P currently is, and you're saying, hey, I can get 4 or 5% in cash. Currently you can get, if you're at Interactive Brokers, you can get 3.8%. That's personally where I keep my investment accounts. Check out the link for Interactive Brokers below. So if you're getting, let's say, around 4% cash, then you're taking risks with the stock market because you might have, fluctuations. You might have recessions. There's business risks. So if cash is yielding 4%, well, you might want 6-7% on stocks. Well, 6-7% on $200 implies around $3,000 for the S&P. So that means 20% plus downside from here. That's before any recessionary contraction in earnings. So that would argue that you're still facing potentially a lot of pain for the S&P over time. That's just dealing with reality as it is. Okay, so you're looking at these things. You're saying there's still a lot of pain to come, potential stock market crash, potential recession. How do I crush these things to make the most for myself? How do I make the most out of this? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. I also recently launched 2 new investment courses for enterprising investors wanting to learn how to read financial statements as well as analyze and value stocks. In full disclosure, this is not financial advice. Okay, so how do you crush the likely continued stock market crash and probable recession in 2023? First of all, you got to make sure you have cash. Make sure you have cash, so at least some sort of emergency fund, some sort of cash position. So that way, if you're part of the millions that will get laid off, which even Jerome Powell is effectively saying, hey, unemployment's going up. The question is, how bad does it get? That you have some sort of cash buffer. That's the first part. The second part is, how do you make the most out of this likely continued downturn? Once again, you need cash. And by the way, sitting in cash, it's not that bad of a deal right now. I mean, once again, getting 4% a year versus, seeing sizable losses. So that gives you some patience to say, oh, okay, I want to get at least 4% plus a lot of upside potential. Okay, so 4% plus 100 or 200% upside potential. And just this past week, I called out a stock that's like 4% plus 100, 200% upside potential that I started nibbling on. So you need to think about cash. Some people prefer to dollar cost average. As long as you're thinking, hey, I'm going to keep putting capital in, as long as you're saying, hey, I'm going to put capital in when there's a downturn, when there's really cheap prices, that is the first key aspect here. You need to be prepared to move capital, move cash in when the bargains are there. Personally, I'm still looking at this and I'm saying, hey, some of the things are interesting. Still, the S&P 500, it's not crazy cheap, 18, 19 times earnings, not deeply cheap. I called out earlier, 3,000 for the S&P based roughly on, assuming a 6-7% yield, $200 in earnings versus the 3,800 that it currently trades at. That's the reality I'm looking at. If you think it's wrong, call it out below. I want to understand how you think I'm looking at reality wrong, or where I'm missing, what piece I'm missing here. The next part, and this is a part that a lot of investors struggle with, is you need to have a high hurdle rate. You need to not only say, oh, this is a great company. You need to say, hey, I can pencil out that this could have a very attractive return over the next 3, 5, 10 years from now. And once again, if you don't know how to do that, I created this valuation course so that way you can start thinking about valuation. But it's also saying, like, look, a lot of investors who did well this past decade plus are mistaking their abilities for picking stocks with the reality of an easy central banker. The reality of, folks are saying, oh, I'm a genius. In reality, you just had easy money. So you need to recognize that prior period of an easy central banker, that's over. Jerome Powell is saying, no, we are keeping things tight until triple cherry, until everything is deflating, until he's firmly confident that inflation is close to 2%. Good chance he overshoots it. Why not? So you look at that. You look at that risk of a real recession. You need to have high hurdle rates. You need to say, hey, you might nibble on things at 10%. Say, hey, I think I can get 10% over time on this. But save the bigger purchases for when you're saying, hey, I'm really penciling out 20% or 30% upside in the years ahead. So first is having capital to deploy. The second key aspect is making sure you have that high hurdle rate. And think about it. Am I getting compensated? Am I getting paid for this likely recession I'm facing in 2023? The third, make sure you own strong companies. A lot of companies won't make it through a recession because they don't have the balance sheet to handle it. They might also not have the business to handle it. They might not have recurring revenue. Maybe it's a business tied to one-time car sales. They're like, oh, I'm selling this car, it trades at 50 times earnings. What if, all of a sudden, consumers are weak, demand drops, and your revenue actually starts declining? What happens to valuations in that situation? So there's a lot of businesses that, will need to have the balance sheet and the income statement, the business model, to do well in a recession. And you should be aware of what you own. What type of business do you own? Do you own something that sells more of a one-time good, or are you selling a type of, or is this business more recurring in nature? Maybe a toll booth type business model, or do you have a business where it's like, hey, I called this out to my subscribers earlier this week. Like the CEO is effectively saying, yeah, no matter what happens in the next few years, we're pretty confident that we're going to be growing at like 15% plus for the next few years. Okay, well, that gets me interested. When you have that level of conviction and you're profitable and you're paying out the cash flow to shareholders, that gets me interested. So you want to make sure you understand, okay, I own strong things that'll be prepared for tough times. Now, the kicker would be if you have something that not only has the cash, not only has that stable balance sheet, but has that cash flow that's getting returned to you as a shareholder. Because then you can have buybacks and that makes it better for you. Or you can have, effectively, maybe it's a dividend. Now the dividend, whatever price you pay, that's going to be effectively the rate that you're getting. But the lower the price goes, you go, wow, effectively at this price, it's this percent yield. Like this is really intriguing. And maybe you add more capital. That gets to point number one, having the capital available. So having a business that has those key elements, strong balance sheet, a strong business model, recurring revenue throughout a recession, as well as the capacity for management to allocate capital that will advantage shareholders over time. So I hope this video talking about how to crush the stock market crash, potential recession in 2023 has been helpful for you. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.